Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to The Bigger Picture. Me, Ryan Huang. And we are looking at the latest earnings season by our three banks. We saw stable earnings for the fourth quarter ended December amid expectations that a resilient ASEAN economy will continue to support their growth outlook this year. We also saw them giving back a large chunk to shareholders in the form of dividends and share buybacks. We have DBS announcing a capital return dividend of 15 cents per share to be paid out each quarter over 2025. It also expects to pay out a similar amount of capital in the next 2 years. This is on top of its $3 billion share buyback program announced in its Q3 results. UOB proposed a special dividend of 50 cents per share, paying out $800 million of UOB's surplus capital over two tranches in 2025, and introduced a $2 billion share buyback program. Meanwhile, OCBC announced plans to return $2.5 billion of capital to shareholders over 2 years via special dividends and share buybacks. So let's break it all down with Rena Kwok. She is the Senior Credit Analyst at Bloomberg Intelligence. Rena, good morning. How are you doing today?
Good morning, Ryan. Thanks for having me.
Yeah, let's talk about what's happening here with a bit of context. Why are banks returning capital? What's driving this? And any surprises with the numbers here?
Yeah, probably let's take a look why are banks focusing more on capital management over the next 1 to 2 years. Now, we believe that the Singapore banks are likely to focus on capital management over the next 1 to 2 years to boost shareholder returns, as excess capital might actually lack productive use, since major M&A plans look unlikely in the near term amid the global risk, as well as strong earnings could continue to support the capital returns and absorb likely modest risk-weighted asset growth this year. Now, we think that capital returns could rise if capital generation strengthens, especially if interest rates are high for longer.
So how much has this improved the ROE or return on equity? And is there more room to do further or more optimization of this?
Yes, I think, as we look into the Singapore banks, definitely they are capital rich. It's a known happy problem. But as we look into the cost of their capital structure, I think that actually warrants more, analysis, right? So based on our calculations, Singapore banks' weighted average cost of capital on a consolidated basis as of fourth quarter 24, that modestly exceeded the lender's last 5-year average. And this could actually signal room for optimization by borrowing as, market expectations of further interest rate cuts. Now, I'll just give you the context, among the Singapore banks, UOB weighted average cost of capital, what we call the WACC, was the lowest, while OCBC WACC ratio was the highest among its peers. Now, with existing capital bonds, meaning your additional Tier 1 bonds as well as Tier 2 bonds, nearing call dates, refinancing potential is again rising, and the lenders could actually, tap on opportunistic borrowing to optimize the capital structure.
Okay, so we have a return of capital from these banks. What are some of the pros and cons when you look at some of these capital return plans?
I think that's probably like answering the $1 million question on everyone's mind. Now, I just want to take a step back. Firstly, the Singapore Bank's capital return plans combining dividends, share buybacks, they have to really optimize the excess capital they have and, remain prudent in actually maintaining their healthy capital base. But of course, like you mentioned earlier, all these strategies have distinct benefits, right? Special dividends offer the flexibility without long-term commitments, while share buybacks boost earnings per share. Now, as we take a look closer into the Singapore Bank's capital return plans, now, unlike DBS and UOB, OCBC focused more on dividends than share buybacks in its return plan that could potentially limit earnings per share upside. You mentioned earlier about the UOB's capital return plan. I just want to focus on the $2 billion share buyback program over the next 3 years. While it could actually support valuation, its longer 3-year execution period might delay the immediate investor benefits. And moving on to DBS. Now, DBS capital return plan over the next 3 years would actually balance what we call the earnings per share growth as well as earnings sustainability with a 15 cents capital return dividend per quarter in fiscal 2025, along a $3 billion share buyback program. And in addition, we saw a 27% year-on-year rise in its 2024 ordinary dividends, making its capital return plan more immediate and effective in our opinion.
Rena, so if what you've outlined, does it suggest that OCBC is more measured and more conservative with its outlook where things are going this year?
I think we have to take a step back to see how much the banks are maintaining in terms of, the capital vis-a-vis their capital return plan. If you see OCBC and UOB, they are actually, maintaining at least a target operating range of CET1 at 14%, while DBS is looking at the midpoint of 12.5 to 13.5%. Now, this could suggest where to see the opportunities as well as the prudence and conservatism in managing the capital. But given that OCBC large capital base, I actually feel that they have room to further optimize its capital structure.
Okay, let's take a look at what's happening in the backdrop of the global economy. And of course, banks do have some exposure overseas in places like Hong Kong. And this is where you have the commercial real estate situation potentially posing some risks. So how much of a risk is this for Singapore banks this year?
Yes, unfortunately, I think the lingering risk in commercial real estate remains to be watched for both Singapore and Hong Kong banks. But really, looking at Singapore banks' exposure to Hong Kong commercial real estate, what we call the CRE exposures, they're actually pretty modest. They're capped at about 4% of the group loans, and the lending is actually focused to the top-tier developers at really low average loan-to-value ratio below 60%. And then Singapore banks have also curtailed their exposures in recent years. Now, that actually makes us more confident about their exposures and the type of exposures they have. And separately, the ample loan provisioning could actually help them to absorb any potential losses should Hong Kong real estate recovery remain sluggish over the next 1 to 2 years.
Okay, so you have that to watch out for. And also, we've got a lot happening with the backdrop of tariffs, trade wars, and so on. What does this mean for Singapore Bank dollar bonds as an option for investors?
Yes, I think, if we look into 2025, I think, Singapore banks, benign asset quality outlook, despite the prevailing risk that I mentioned, there's some lingering to watch in, commercial real estate, but that is unlikely to be a material risk. And, along with the ample capital cushions, despite the capital return plans and provisioning, this could actually give their bonds a safe haven status amid the macroeconomic uncertainties and global trade risks. Now, we do expect the Singapore bank bonds spreads to remain range-bound this year, but there seems to be very little room for substantial tightening at current levels, as many of the positives have been priced in by the market.
All right, that's a great wrap-up of where things are and the share buyback and capital return plans of our three local banks. We've been in conversation with Rena Kwok. She is a senior credit analyst for Asian financials at Bloomberg Intelligence. Rena, thanks so much for your time and insights today.
Thank you for having me. Take care.
All right, great having you on. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.